Welcome to the TaxSlayer Pro Basic Income Tax Preparation course. This is Module 5. We're going over Income, Part 3 for filing 2018 tax returns. And in this module, we'll be going over Schedule D and Form 8949, capital gains and losses. Buy low, sell high. If you do that, you'll be a successful investor. You'll also have capital gains. A capital gain or loss is a gain or loss on the sale of almost any asset. Gains and losses which don't relate to the sale of business property are first reported on IRS Form 8949. Any gains or losses relating to the sale of business property are first reported on Form 4797. The subtotals are then carried over to Schedule D, Form 1040. The sale of a personal residence is reported only if there is a gain in excess of the excludable amount. Report this gain on Form 8949 in Schedule D. We'll go over this excludable amount in just a few moments. The IRS defines a capital asset as almost everything you own and use for personal or investment purposes. That's a lot of stuff, so technically, yes, you'd have to tell the IRS about that collector's item Beatles record that you sold for a nice profit on eBay. But the most common taxable assets are securities, real estate, and valuable collectibles. Securities are any kind of financial instrument or investment contract that has value. Examples are stocks, bonds, and options. It's important to understand that you'll only be taxed on stocks and securities that you've sold in the past year, only those that you've sold. If your stocks go up during the year, but you hang on to them, you won't be charged any capital gains tax. If you use a broker to help buy and sell stocks and bonds, then the brokerage firm will send you a form at the beginning of the tax year called a 1099-B, Proceeds from Broker and Barter Exchange Transactions. This form lists all of your earnings and losses from the sale of securities. Here's an example of a 1099-B showing a description of the property, the date acquired and the date sold, and the proceeds and the cost basis. It's typical for the brokerage firm to list the earnings as net proceeds, and this means how much you earned minus any commissions or brokerage fees. If they list gross proceeds, then you'll have to deduct the commissions and fees on your own. If you sell real estate or property, either for personal or business purposes, and make a profit from the sale, then that also qualifies as a capital gain. That will show up on Form 1099-S. And this form shows the gross proceeds from a sale or trade of reportable real estate. And this form will be provided to the taxpayer by the real estate company. Different tax rates apply to sales of personal property and business property. And thanks to the Taxpayer Relief Act of 1997, there are significant tax breaks when you sell your primary residence, your home. According to the 1997 law, if you've used a home or apartment or trailer or even a houseboat as your primary residence for at least 2 out of the last 5 years, you can exclude up to $500,000 in capital gains from the sale of that property. The $500,000 exclusion is only for married couples who file a joint return. Individual filers can exclude up to $250,000. That means you don't have to pay taxes on money made from selling a primary residence unless the earnings exceed $250,000 or $500,000, depending on your filing status. To qualify for the exclusion, during the 5-year period ending on the date of the sale, the taxpayer must have owned the home for at least 2 years, this is the ownership test, and lived in the home as his or her main home for at least 2 years, this is the use test, and in addition, during the 2-year period ending on the date of the sale, the taxpayer must not have claimed an exclusion on a gain from the sale of another home. Now, figuring the gain or loss on the sale of a home is based on the selling price, the amount realized, and this is the selling price minus any selling expenses, the basis, and the adjusted basis. This adjusted basis is the cost plus any capital improvements that were made. Now keep in mind, a loss on the sale of a personal residence is not deductible. Even if any profit isn't taxable, a taxpayer who receives Form 1099-S for gain or loss on the sale of a main home must report this information on Form 8949 and Schedule D on the tax return. Sales of art, rugs, antiques, jewelry, precious metals, wine, stamps, coins, and other valuable collectibles are also taxable as capital gains. In calculating capital gains, the first step is to calculate exactly how much capital gain income you've earned in the last year. This sounds easy enough. All you have to do is take the sale price of a capital asset, which is a stock, real estate, so on, and subtract the original purchase price. But it gets a little tricky if you're not the person who originally purchased the asset or investment. The original purchase price of an investment, like stock, other securities, or investment property, is known as the cost basis. There are several different ways to calculate this. If you purchase the investment, then the cost basis is simply the price you paid for it. If you inherited the investment, then the cost basis is the value of the investment on the date that the original owner passed away. If you receive the investment as a gift, then the cost basis is the original price of the asset, unless the investment was worth less than that amount when it was given to you. Once you've figured out how much you've earned from the sale of each asset, you next need to figure out how long you've owned each asset. This is called the holding period of an investment, and it's divided into 2 categories, each with a different tax rate. Short-term property is property that's held 1 year or less. Long-term property is property held more than 1 year. Holding period of an asset is measured in calendar months beginning on the date after acquisition and including the disposal date. For example, Lorna bought 100 shares of stock on January the 1st, 2018. To determine her holding period, she should start counting on January the 2nd, 2018. The second day of each month thereafter counts as the beginning of a new month, regardless of how many days each month contains. If she sells the property on January the 1st, 2019, her holding period will be 1 year or less, and she'll realize a short-term capital gain or loss. If she sells the property on January the 2nd, 2019, her holding period will have been 1 year and a day, and she'll realize a long-term capital gain or loss. Let's take a look at another example. If you bought investment property on February the 3rd, 2017, and sold it on February the 3rd, 2018, your holding period isn't more than 1 year. You've got a short-term capital gain or loss. If you sold it on February the 6th, 2018, your holding period is more than 1 year, and you'll have a long-term capital gain or loss. For inherited property, by law, all inherited property automatically has a long-term holding period assigned to it. It may not seem logical, but the mechanism of inheriting property always changes the holding period from short to long. IRS Publication 544, Chapter 4 states, inherited property. If you inherit property, you're considered to have held the property longer than 1 year, regardless of how long you actually held it. So why is it so important to determine the holding period, to determine long versus short term? The answer: short-term gains are taxed at regular income tax rates. Long-term gains are taxed at a lower rate. Starting with tax year 2011, capital gains are reported using Schedule D and a new form for that year, Form 8949. This was a major change from previous years when just the Schedule D was used to hold these transactions. Details regarding individual trades are reported on Form 8949. Totals from that form are then summarized on Schedule D and then transferred to Form 1040. Here's an example of Form 8949. It's organized much like a spreadsheet with all the essential information about each investment you sold during the year. The capital gain or loss is reported for each transaction, then your total gains or losses are figured. You'll have either a net profit or a net loss from all of your trades. To complete the form, to complete Form 8949, you'll need the following information for each sale, each transaction that you make: a description of the property, the date you acquired the investment or asset, the date it was sold, the amount it was sold for, the tax basis or the cost. And to help you with these entries, again, Form 1099-B is sent by the asset broker. Now on the Schedule D, you'll see 3 sections. Part 1 for short-term capital gains and losses. Part 2 is what you use to report long-term capital gains and losses. And Part 3 is the summary of both short and long-term gains and losses. The calculations flow from Schedule D, Part 3, and the total amount transfers to the new Schedule 1, line 13. Then to Form 1040, page 2, line 6. So again, go over the flow once more on these transactions. Form 8949 flows to Schedule D. Schedule D flows to the new Schedule 1. Schedule 1 flows to the 1040. So let's look at capital gains tax rates. When long-term capital gains are included in total income, then federal taxes are calculated using the Qualified Dividends and Capital Gains Tax Worksheet, not from the tax tables. The capital gains tax rate can be 0 if the taxpayer is in the 10 or 12% income tax brackets. So let's look at this gentleman's return, Brady Quinn's tax return, and how to calculate his income tax on his capital gains and the rest of his earnings. First, we find the taxable income from page 2 of Form 1040 to use for the capital gains tax worksheet. And there it is on line 10, the taxable income. We would look in the tax tables ordinarily and see that the taxable income on his amount, the tax from the tax tables, is $38.83. filing head of household. However, the actual tax calculated on the return from the capital gains tax worksheet is much less, $33.97, a difference of $486. Well, here's why. The qualified dividends and capital gain tax worksheet takes this into account. If we look on line 26 of the worksheet, there's our tax that we saw from the tax tables, $38.83. However, because there's capital gains on the tax return, we use the tax amount of $33.97. So again, let's jump back for just a moment. Remember our discussion of the Form 1099 DIV gets reported on line 3A of the 1040. If a taxpayer has both a Form 1099 DIV and Form 1099B, then any capital gain distributions from the 1099 DIV Box 2A are added to the Schedule D transactions. So just what are capital gain distributions? Well, capital gain distributions are capital gains, increase in value of an asset, that are passed on to investment company shareholders. How do they work? Example, let's assume that the Acme Company's mutual fund invested well during the year and they realized $1 million in net capital gains. The fund has 10 million shares outstanding, and you own 1,000 of those shares. Because you own 0.01% of the fund's total shares, you're entitled to 0.01% of the net capital gains, or $100. The capital gain distributions are added to line 13 in Part 2 of Schedule D and are taxed at the long-term capital gains tax rate. The reason behind all of this? To encourage investment. So what if I lose money on my capital investments? Well, for example, David Macaroon sold 3,000 shares of SRO stock for $2,000 on March the 1st, 2018. He purchased the shares on January the 10th of 2009 for $10,000. So he's got a loss of $8,000 to report. How does he report this capital loss on his 2018 tax return? Well, page 2 of Form 8949 lists the long-term loss of $8,000 on the sale of the SRO stock. The loss transfers to Part 2 of Schedule D, and the Macaroons can only claim $3,000 of the capital loss on their 2018 tax return. So what happens to the rest? Well, there's a capital loss carryover for the next tax year of $5,000. So first, in talking about the capital loss carryover rules, any capital loss that's not used in the current year can be carried over indefinitely to offset future capital gains. For example, if you have $10,000 of capital loss after using $3,000 to offset ordinary income, $7,000 will carry over to the next year, to the next tax return. In that next year, if you have $5,000 of capital gain, you can use $5,000 of that loss carryover to offset this gain and use the remaining $2,000 to offset any ordinary income. Second, $3,000 of a capital loss can be used to offset ordinary income. For example, if you have a $10,000 capital loss and no gains, you can use $3,000 of the capital loss to deduct against ordinary income. You're limited to $3,000. If your ordinary income is $50,000, you get to deduct $3,000 of capital loss, and so you'll only pay tax on $47,000 of ordinary income. Third, capital losses are used to offset capital gains. For example, if you have a $10,000 capital loss and a $10,000 capital gain, they'll offset each other. Next, on the subject of non-business bad debts, if someone owes you money that you can't collect, you've got a bad debt. You may be able to deduct the amount owed to you when you calculate your taxes for the year that the debt becomes worthless. Generally, non-business bad debts are bad debts that didn't come from operating your trade or business and are deductible as short-term capital losses. To be deductible, non-business bad debts must be totally worthless. A debt must be genuine for you to deduct the loss. A debt is genuine if it arises from a debtor-creditor relationship based on a valid and enforceable obligation to repay a fixed or determinable sum of money. To deduct a bad debt, you must have a basis in it. That is, you must have already included the amount in your income or loaned out your cash. You take a bad debt deduction in the year that the debt becomes worthless. A debt becomes worthless when there is no longer any chance that the amount owed will be paid. You must only show that you have taken reasonable steps to collect the debt. How do you report bad debts? You deduct non-business bad debts, again, as short-term capital losses on Form 8949. So in summary, what's a short-term holding period? 1 year or less, taxed at regular income tax rates. What's long-term? More than 1 year, long-term capital gains are taxed at a lower rate than short-term capital gains. Brokers report information about the sale of stock on Form 1099-B. They should report the cost or other basis and whether or not the gain or loss is short-term or long-term. Use Form 8949 for reporting the details of capital gains and losses. Short-term transactions go on Form 8949 page 1. Long-term transactions, 8949 page 2, and the totals transfer to Schedule D. The most net capital loss that a taxpayer can take in a single tax year is $3,000 or $1,500 if married filing separately. And now let's take a look at a few review questions.